everybody, and welcome to our discussion on personal finance, specifically with the credit reporting and scoring, understanding both the credit report and the credit score. So, as you probably already know at this point in your financial life, both the credit report and the credit score can impact very different areas, not just with borrowing, although, of course, that's certainly a very big piece of it. It may also impact your ability to get a job, depending in part on what job you're looking for, what industry, what those employers look for. It may impact your ability to rent a home. Now, it makes sense that it would impact your ability to buy a home, but many people don't understand this may also impact your ability to even rent a home, depending, of course, on whether the landlord looks for credit reports or credit scores as part of their background. Another thing that may come as a surprise is that it'll also impact the rates you pay for insurance through your insurance company, whether that be car insurance, home insurance, whatever type of insurance. Although it seems a little odd that they would use your financial history to determine your risk as far as wrecking a car, getting in an accident, things like that. It seems a little odd, but they do indeed do that. And if you have seen your insurance rates increase recently, part of that you want to see if that ties to any sort of decrease in your score. Maybe there's something you're not even aware of there. Now, the thing is with insurance, as soon as they identify a sudden decrease in a score, it may not have that long of a time before you see an increase in your insurance rate. Unfortunately, the opposite is not necessarily true. If you have a credit score increase, you may not see insurance savings right away. Now, different insurance companies have different policies in place. Some of them you can actually request. A lot of times it's once a year. You can request a reevaluation of your rate, and that'll take into consideration your credit score as well. So, we're going to talk about a few tips on how to improve your credit throughout this discussion. If you are able to see a score increase, you might want to think about these things, especially this insurance. You might want to see if it's time for you to try to get a re-rate for your insurance. So let's start off this discussion with what is a credit report, and then we'll talk about the score later on. So the credit report in general is basically a history of everything you've done financially with various companies. Now, I say over the past several years here, generally we're talking up to 7 years. There are some things that can last longer than that, but generally 7 years is the limit. And in fact, some things fall off or become less and less important even after a couple of years. But depending on what it is, it could last around 7 years. So the credit report, now it doesn't necessarily include every single thing you've done financially. Part of it depends on what that company does as far as reporting. Some companies do not report to the credit unions, to the credit reporting agencies. On the other hand, some of them do very diligently every single month. So part of it is just understanding what accounts do you have, trying to identify the policies of that particular company. Now, the way you'll identify the policies is sometimes basically by looking at your credit report, as we'll see later on, just trying to identify how frequently do they update, or do they update at all. And we'll talk more about that in just a bit. But basically, the credit report tracks the balances of your accounts, any credit limits on your accounts. It tracks the age of the accounts, when they started, assuming they're still in existence. By the way, once you close an account, I want to throw this out here. You could have had an account for 30, 40 years. Once you close it, it's as if you never had it. So that's going to become a very important piece later on. Be careful of closing old accounts. It'll also track your payment or past due history. And that last piece is what most people think of when they think of a credit report, just payment history. Now, certainly that's a big piece of it. In fact, it's the largest piece of it, but it's not the only piece by any means. So again, what you have in your credit report doesn't last forever. So if you did make some mistakes when you were younger and now you're 30, 40 years old and trying to maybe buy a home if you haven't already, or try to get a new job, those mistakes from more than 7 years ago aren't going to haunt you forever. So that's a good thing. The thought is that people can change, people can improve their situation, whether that means they've got a new job or they were able to get rid of some debt. So whatever the case is there, the credit report considers that possibility. And what I want to mention here, I want to throw this out. Now, everybody is starting from a different place. Things may have happened in the past, and maybe you were unable to pay some of your bills. Maybe you've lost your job. Obviously, at this point in this year, there are a lot of people nationwide that are having bad situations. It's a bad time for the economy financially. So that's one of the concerns. What is that going to do to everybody's credit report? So there's no judgment here. This video is certainly not about judgment. We're basically trying to identify what can be done to improve your credit report, or at least what is in your credit report, how to check for inaccuracies, what it means, what all of that means. That's what this lecture is really all about here. So why is there a credit report? The thing is, companies, whether it be a car dealer that you're buying a car from, a bank you're mortgaging a house from, or whoever, a credit card company, they don't know you. It's not like it used to be decades ago where you'd go down to your corner store and you'd set up a tab with that local grocer. They have some sort of relationship with you. They knew you, and if nothing else, they knew where to find you. So it's not the same situation anymore, or very seldom is at least. These banks, these large companies, are taking a risk on you. They don't know you personally, and they really don't know how to necessarily find you if you intentionally decide not to pay. So they're taking a risk when they lend to you. Now, there, of course, would be two different types of debt. We have unsecured debt, which is the biggest risk for them. If, for some reason, a person takes out a debt and decides not to pay it, if it's unsecured debt, there's no underlying asset for that company to come after. At best, they can seek a judgment through the courts and try to compel you to pay that way, but there's no specific asset tied to it. Whereas secured debt, like a mortgage or a car loan, there's collateral there. It's easier when they need to seek a judgment. They can get that particular asset. It's already tied up. They have first dibs on that asset, basically. So you have to understand that companies are taking a risk. Now, they need to know something about you. They don't know you personally, so they rely on this trusted credit reporting agency to report your past history. That gives them a better picture of how you've acted in previous financial situations. Now, you might think, well, hey, it doesn't seem fair that my score is dictating so much of my life. And I know that comes across seeming a little bit unfair. You might question, well, why don't we just do away with credit reporting altogether? Credit scores, get rid of them altogether. The thing is, if that were to happen, if credit reports and credit scores were to be completely eliminated, everybody would see the rates for borrowing to be considerably less favorable, which means higher rates. The availability of borrowing would shrink up like crazy because the risk would just be so high. These companies would have nothing to go off of whatsoever as far as whether you're a good risk or not to lend to. So the market would tighten up so much, the credit would tighten up so much that it would be extremely difficult for virtually anybody to get credit. So that's the importance of a credit report. And what this lecture is really all about is just showing you what you can do about it. There are the rules out there. It's the game, so to speak, the credit report, the credit score. So we need to know how to play the game. And I don't mean that in a way, unethical way by any means. I'm trying to show you the rules of the game, how we go about and how we work within those confines, those constraints. So that's what this is really all about. So first of all, who controls these credit reports? We have three main credit reporting agencies in this country. We have Experian, which actually that firm, in its beginning, it's been around since 1826, which seems very odd Now, of course, it's evolved a lot over the years, and it serves a different purpose, more focused purpose, I guess you could say. But the entity itself has been around since 1826, or at least the company that eventually evolved into Experian. That same statement would be the truth for Equifax and TransUnion. Equifax has been around since 1899. TransUnion, quite a bit later, since 1968. So the thing to remember here, these are all publicly traded companies, and they're not at all a government agency. So when you think credit reporting agency, it's not part of the government by any means. It's independent of the government. Now, I said earlier that not all information about your accounts may be in every or all three of those credit reporting agencies. Different companies have different policies. Some of them report to all three, some report to no credit reporting agency, and some may just pick one or two to report to. So, for that reason, it's important to check all three of these credit reports separately and regularly. And again, you might find also, even if a company does report to, let's say, all three, maybe they don't report with the same frequency to all three. They may report to one of those credit reporting agencies every month, but the other two maybe every 3 months or every 6 months or just on an irregular basis. So I said we need to check those credit reports, and that brings up the biggest question: how do you check your credit report? In this day and age, there are several different ways to check your credit report, but the one that was mandated by the government is a free annual report from each agency every year. This website here, annualcreditreport.com, it's an independent website. It's not with any company that charges you. It's a free credit report, and they're obligated, legally obligated, to give you one credit report each year. Now, you can call this number or you can go to the website. You can also get a free credit report from whichever agency gave their credit report information to a creditor. So if you were denied credit, then you'll get a letter, first of all, saying, hey, we denied you for this reason. We use this credit report agency. We use the information from this credit reporting agency to make our decision. You'll have 60 days to request a copy of your credit report that was used at that time. So for this, you'll want to see any sort of decline letter that the company sent you, and just follow the instructions there. It'll tell you how to report it or how to request it. Again, each of those agencies, you want to check that report, whether you do it once a year or possibly more frequently through credit monitoring, and I'll mention that in just a bit. But here's the information about each of those three entities. So you can call them, you can go to their website, you can mail them. Now that information is handy, especially if you find an error. If you need to dispute something and you have documentation to show that that is in error, this is the address you'll want to use, or you can use one of their electronic options. A lot of times through the website, they allow electronic dispute. So that's the information for them. Now we're going to come back to that in just a bit. In the next couple of slides, we're going to see various websites, including those three websites. But before we do that, let's move on to the topic of credit scores. So the credit report tells the narrative. It tells all the detail about what has happened, what the history is. But the credit score quantifies that into one element. Takes all of that information and gives you one score. Now, a lot of times those scores, depending on the methodology they use or depending on the exact type of score, they sometimes range from 350 up to either 800, 850, 900. I've seen a few different models. FICO, for example, is one of them. Now, FICO, by the way, stands for Fair Isaac Corporation, which, if you've heard that before, it's basically two people's names, Fair and Isaac. They were the first people to put together one score that combined all of this information, that quantified all this information. So that's what FICO stands for, Fair Isaac Corporation. And that's not the only one by any means, but it's by far the most commonly used one. Generally, the FICO scores, I think I've heard that they're used in anywhere from 85 to 90% of all credit decisions. So that's pretty huge. Now, again, even within FICO, there are several different submodels of FICO, but really they all should trend in approximately the same way. So if you fix something in your credit report, it should have some impact for most, if not all, of those scores. Now, different scores focus on different elements more than others, and we're going to see some of those elements in a bit. But I just wanted to mention that the credit score ultimately is what you need to know about, and really seeing the trend over time helps you. Knowing where you stand and dealing with it, saying, hey, I'm right here right now. Things have happened in the past, perhaps. Here's where I am right now. What can I do to improve it to make life easier in the future? That's really what it's about. So the financial world works on those scores. Now, the credit report is nice. You can see it. Those are the things you might need to fix to improve that score. But every lender is not going to take a look at your entire credit report and try to digest all of that information. They're going to start with a credit score and see if you even qualify for whatever lending they're offering. So the score determines, first of all, whether you're eligible for a loan. And then secondly, if you are eligible, what rate are they going to charge you? Now, I want to throw one important piece out here right now. We talked about the score itself, but there's also just the ability to pay, your income. Now, that's not reported on your credit report. You're going to have to document that separately through the lender. But you have your income, and let's say you make plenty of money for this particular loan, but then they take a look at your credit score, and it's not what they want. It's lower than what they require. Even though it appears that, hey, I could pay it, I have plenty of money here, they may decline you just because of your credit score. On the other hand, let's say you have a near perfect credit score, but you don't make a whole lot of money. You've just handled your finances really well, but you just don't make a whole lot of money. And let's say you're going out there and you're trying to buy $1 million home, for example, but you don't make a whole lot of money. Even though your score is perfect, they're going to say, well, this makes no sense. Yeah, you've done a great job of managing your finances in the past, but it looks like if you were to get into this loan, you're going to run into some significant issues, which could cause you significant problems down the road as well. So they're probably going to decline you there on that front. So that's just one thing I want to throw in here. But again, the thing is with these scores, you want to have an idea of what your score is on a pretty regular basis, but it becomes even more important in the months leading up to a large purchase. Like if you're going in for a car loan, if you're going in for a home loan, trying to check your credit report a week before one of these purchases isn't going to do you much good in most cases. I will talk about a few tips later on that can help. But the point here is that you want to look at it well ahead of time. I would suggest 2 to 3 months at least to give yourself a chance to clear up any issues with whatever reporting and with all 3 credit agencies, because that's the other thing. You don't necessarily know unless you've had past transactions with this lender, or maybe you can find some research online about that particular lender, but you may not know what score they use. Some of them use just one score all the time. Some of them rotate through the scores depending on the type of lending, and others, especially mortgage lenders, they may take a look at all 3 scores, and sometimes they'll use the middle score because they realize that there might be things on one entity that haven't been corrected, and there might be false data or just not corrected data on one of the others. So they use the average, and I should say the middle. They don't use an average. They generally use the middle score of the 3. So that's important to be aware of. But again, whatever your score is, know about it. Identify it, try to figure out what you can do to improve it. So let's take a look at this next one. How do we find your credit scores? Now, there are different options. I'd say in the past 10 to 15 years, these have increased drastically. In the past, again, FICO was the main one. They were the first one for sure. And sometimes, at the beginning, you wouldn't even know what their score was. You wouldn't have a good way of getting that score other than getting denied. And sometimes they'll tell you, here was the score. We require, whatever, a 620, 670. But then maybe you're a little bit below that. So in the past, that was the only way to find the score. The scores were somewhat secretive. Only lenders could see them. But they've really become a little bit more transparent. I should say quite a bit more transparent over the years. They give you different ways of seeing the score. Now, again, though, I want to point out, because there are so many different models of those scores, you may not be able to tell perfectly what score your lender is going to see. You might pull it out and it might show a 640, but then the lender sees it, maybe it's a 615, and maybe they needed a 620 to lend you. So that causes a little bit of frustration, but the key thing is if you understand where your score is and you understand what hits that score, do what you can to improve that. That's the key point I'm trying to make here. So nowadays also, even more transparently, a lot of credit cards or bank websites, they'll even give you access to a version of your credit score. And you can check it sometimes once every 30 days. It'll update for you. So a lot of times those are free. There are different credit cards out there that do this. Just if you have a credit card, log on to the website with your account and everything and see if there's anything about check your credit score, free credit score, things like that. That helps. But again, the model may not be the one most commonly used. So there are other websites here. Some of these charge. Some of them are completely free from the beginning, and some of them have both free and cost-based options. So there are others out there. These are just 6 of them that I've gone through before, that I've researched and used in the past. So what I want to do here is actually show you these websites. Now, here are the links, but I've got all of them up, and I'm going to talk about that. Now, I do have to add in a disclaimer here that these websites are obviously the property of these companies, and they may change from time to time. This is as of September 20th. You might log in here tomorrow, and they might have tweaked their website a little bit. So keep that in mind here. CreditKarma.com. You'll hear that quite a bit on TV. They do a pretty good job of advertising their options, or at least they used to. And it start off, as you can see right here on their website, your credit score should be free, and now they are. This is a free option. Now, I will tell you, there's nothing free. You hear that quite a bit. No such thing as a free lunch. Really, the way this website, as many websites work, is based on advertising. It's no different than television and how you can get non-cable television for free. It's based on advertising. So they are advertising. When you log into your credit score here, they're going to give you offers to different lenders. Based on your credit score, they'll say, hey, you might qualify for this or that. Do you want a credit card? Do you want a loan? Now, if it's something you need and you think it fits your situation, sure, go for it. But just don't get accounts just for the heck of it. Because, as we'll see in a little bit, having too many accounts, especially new accounts, isn't necessarily a good thing. It could harm your credit score. So just be careful of that. So again, it's free. You'll want to log in. You can sign up for free. You can check these on a pretty regular basis. It does give you it gives you 2, if I remember right, 2 of the different companies. I do not believe it gives you Experian. It gives you TransUnion and Equifax, but they do not have Experian, at least the last time I looked at it. So feel free to check these out. Again, anything I'm saying right now could change. So check it out there. This company, this Credit Karma, has expanded quite a bit since they started. So you might find some other things that are interesting here. But the big thing I'm pointing out is just the credit score option. True Credit is one of the other ones I used. In fact, I used that before Credit Karma was even around. And notice, as you can see from their website, they do give you all 3 companies. The website there, they call it the MyVantage score. So it's not a FICO score, but again, they all serve a purpose. If you have improved let's say your MyVantage score, chances are your FICO score is going to be improved as well. Maybe not by the same amount, but again, it's all about doing what you can to improve it. So this one, see, it looks like they don't. If you click on this, I'm sure they tell you the price. Sometimes they're $29.99. Oh, here we go. One time 3-in-1 report with scores is $14.95 per month with monitoring there. Credit monitoring, by the way, that basically means that they're going to check for anything that impacts your credit score, and they're going to give you an alert of some sort saying, hey, you signed up for a new account, that harmed your score. You went past due on an account, that harmed your score. Maybe you're improving something, that helped your score. So that's what this is all about. Feel free to check them out. Sometimes they'll offer a trial offer. You know, you might find a situation where you really want to be on top of your credit score, even if you're not looking for loans at that point. Maybe you're interested in refinancing. So I'll just mention here that yes, there's a cost, but you might find it worth it depending on your situation. So just think about that. Think if that fits into your budget. It's always cost versus benefit. Here's the cost just as an example. What benefit do you have? Maybe it's simply peace of mind. Maybe it's that you want to get better rates for your loans. Just whatever the case may be. So there's True Credit. It's a pretty good one. My FICO. Now, here you can see some very clear prices, which again, they can completely change. I've used my FICO before as well. In fact, there have been times if I'm getting prepared for a mortgage or a refinance, I've used a couple of them to see the different scores, see what's on there, just to be very cautious of what's on there, make sure I've got everything set up the way I need to. So you can see there are different options here. This one, this basic, just gives you a one bureau. It's Experian. The advanced gives you 3 bureau coverage, but it only updates every 3 months, which if you're trying to make changes and improve things, 3 months might not be enough. You may need to see an update every month, which would be the Premier. Now again, $39.95, that's a pretty steep price, especially if you're struggling financially anyways, you wanting to pay some of these off. So just consider, is it worth it for you for your situation? Maybe you don't want to do it every month for every year. Maybe you just want to do it for a couple of months leading up to a loan. You can cancel these at any time, so just pay close attention to that. A lot of times they offer the identity theft insurance nowadays. That's always handy. Experian, I use actually Experian right now. That's one I go through. But the interesting thing is Experian and many of these options, they do offer a 3 agency report. So you can go through here so you can see 3 bureau credit report and scores. Just as an example with Experian, you can technically update your Experian report daily and see new scores. And I guess you could potentially multiple times a day. There's no limit to Experian updates. But for the other updates, the other 2, they restrict you to once every 30 days for free, or you can pay the extra fee and do it whenever you want. So they have that. Now, I just noticed that they've also offered some free options sometime recently, so you can check into those as well. So take a look at that. That might be handy for you. As you can imagine, the free options probably aren't going to be as in-depth as the paid options. That's just the nature of it. But some information is better than no information. TransUnion, it's going to be very similar. They have the 3 bureau alert. You could probably see the prices. You might have to go in there. Here's, I guess, is a $24.95 per month. So take a look at those. Again, things can change. And then Equifax has the same thing. A Premier, a family plan. That's pretty handy there. You can add a second adult and up to 4 children. So that's very good. You know, one thing I will mention on that note, there have been instances of credit fraud over time where your children that are under 18 who certainly haven't done any borrowing, sometimes fraud may affect them. Now, don't want to scare you by any means, but it might not be a bad idea from time to time at least to check your children's credit report. Hopefully it comes back 0, nothing whatsoever. That's what you want if they obviously haven't had any accounts. But just to make sure. So just one thing to mention out there. So this is a pretty interesting little option there. And those are the three, or those are the websites that you can check out. You might have others that work. Feel free to use whichever ones you think are handy for you. So now I wanted to talk about the actual components of the credit score. This is what you probably clicked on this YouTube video to really look at. Now, I also want to mention that this percentage breakdown, it's not going to be identical for every specific model. They all have their own breakdown, but this is a pretty standard one, give or take a few percentage points. So the 5 main items that impact your credit score. The biggest one by far is your payment history, and that's what you're probably already familiar with. I'm just going to say it's a 35% right on average. We'll talk about each of these in detail in the next few minutes as well. Credit utilization. So what percentage of your credit limit are you using? 30% there. The length of credit history or your average account age, that's a little bit less. It's 15%. And the fourth one may seem a little odd, but new credit or seeking credit, 10%. It's not a very big item, but it still does hurt you if you're out there searching for several different credit cards, for example. So all of a sudden, if you've opened up 10 new credit card accounts in the past month, that's going to have a hit on your credit score, and that's going to ding it a little bit. So be very careful when you go into some of the retailers and they say, hey, would you like to sign up for a credit card? Unless you really think you have a need for that credit card, or if there are really some benefits that you think will benefit you, I would say decline it, because that's going to hit your credit score. Maybe not in a huge amount, but every little bit counts. So don't just open up credit cards just for the heck of it. Make sure there's a need for it and you've thought it out. Credit mix or types. So this one you might not even be aware of, but basically they're saying, what types of credit do you have? If your entire credit history is just a bunch of credit cards and that's it, that's not going to look as good as it would as if you had some credit cards, a car loan, maybe an installment loan, a home loan, student loan. The more diverse your credit history is, the better your score will be. Now again, that's only 10%, but again, every little bit counts. The idea there is that when you have a broader history, that lender sees, hey, apparently they're financially responsible. They've had relationships with different types of lenders. They've handled them well, so I feel more comfortable lending to them. Now, I want to mention just as a disclaimer, all of these percentages are just estimates. The weighting may change depending on the model of the score you're looking at. So now let's dig into each of the different components in more detail. So payment history, 35%. Again, the credit reporting agencies only know about accounts that go 30 days or more past due. I want to point that out because that's handy to know. There might be situations where you accidentally forgot the due date, you're a few days late, and yes, with that lender, especially if it's a credit card or something like that, there's probably going to be a fee. You might be able to get them to waive it, or maybe not. So with that lender, yeah, it's not good to be late, but if things do go late, if you need to wait till payday to pay or something like that happens, things happen in life. Everybody understands that or should understand that. But what I want to point out here, as far as your credit report or score, please make sure it doesn't go 30 days or more past due. That's when it's going to hit your credit report. If you happen to have had accounts that are 20, 25, 29 days past due, they will never make it to your credit score. They can't. So that's a good thing, at least. It gives you a little bit of a grace period. It doesn't mean it's not going to hurt your relationship with that one creditor, but at least it won't show up on your permanent credit score record. So 30 days or more, and by the way, I do mean 30 days. So it's not always the same as a month. Some months are 31 days. One of them's 28 or 29 days, February. So count the actual days, and on day 30, that's when it could be reported. So be very careful in your counting. 60 days or more hurts the score even more. You really want to try to avoid the 60 days or more because these things could stay on your record for 7 years. Generally, they have an impact for about up to 2 years, and then after 2 years, they become significantly less important to any future lenders and significantly less important in your score. So things do get better. Time does heal the credit score as long as you're improving your financial accounts. So this is the payment history. It's also the percentage of accounts that are always paid as agreed, the length of time since the last payment on any account, and what I want to throw out here is that if you have a collection, try to avoid those at all costs. A lot of times companies will wait sometimes 90 days, but more often like 120 or maybe even 150 days before they send something off to a collection agency. Try to work with that creditor. Pay whatever you can. Set up a payment plan. Really try to avoid the collections. And of course, derogatory public records would take that to an even greater step. This is where they filed a lien against you. They have a judgment against you. Those go on your credit report, and they have a huge impact. They're a big blemish that's very hard to come away from. So just try to avoid those at all cost. Credit utilization. This, I will mention, is one of the things you have the most power over. This has 30%. It considers the number of accounts with balances. Now, I want to underline that or really focus on that with balances. Having a bunch is not necessarily good, but having some is good. So I'm going to throw something out here that may seem completely counterintuitive. Don't close your accounts without thinking about the potential impact on your credit score. And I will also throw out, don't pay all of your accounts down to zero all the time. Now that seems very odd. It seems like zero is a great balance, but zero is an inactive account. Pay it down to $5. Charge one of your meals on it each month and then pay the balance off. That's fine. You can pay it off at the end of the month, but then put a few bucks back on it so that when it gets reported, it has a balance, but a small balance. If it's reported as zero, it tends to reduce the impact of it on your credit score and your credit report. You'd think that, hey, this is a great thing to have zero credit due, but no, that's not necessarily a good thing. You know, on that same note, I'm going to throw another thing that seems odd out. Some people go down the path where they say, hey, I don't like having credit at all. I like paying for everything in cash. If they are fortunate enough to be in that situation, I would argue that in this day and age, that's not necessarily a good thing because you never know when you're going to need to borrow money. If you go through your life and you pay for everything in cash, again, you've had a great job, whatever, you pay for everything in cash, yeah, it's nice not having debt, but the problem is 5, 10, 20 years later, now you need to borrow money for a new house or student loan. You're not going to be able to. You have no credit history. So that's the problem with it. I would say the better approach is to get a reasonable amount of credit, whether it be a small car loan, small credit card, whatever, and then manage it well. That's the best way to work this. So the utilization here is the big thing. It considers the total revolving debt, like credit cards generally, divided by the total revolving credit limits. So if you have $100, or let's say you have $1,000 credit limit, and you've used up $900 of that $1,000, you have a 90% utilization. That's not going to look very good on your credit score. To be the best there, they want you to get your credit utilization down below about 7%. So yeah, you might use your credit card, but then pay it really low by the end of the period before they report that credit card. That's the best. So again, don't necessarily pay it to zero, but pay it very close. Increase your credit limits when you can within your level of responsibility. So think about yourself. Will you be able to handle the situation when you have a high credit limit, or will you be tempted to spend it? Now, that temptation's out there, so you really have to think about your own situation, understand yourself there. I just want to be cautious with that. Some people can fall into a trap where they're tempted. They get this, $1,000, $2,000 limit, and they may be tempted to go buy stuff. Again, no judgment whatsoever. Every person has their own things to deal with, but just pay close attention to that. Consider yourself. But the credit limit being higher as far as your score goes will be better. Also, don't have any individual account over the credit limit or really even close. So let's say you have 10 accounts, which that's a little high, but let's just say there are 10 accounts there. 9 of them are paid down to near zero, but then you have one of them that you maxed out or it's over the limit. That's still going to have an impact on you. Yeah, it's not going to be as big of an impact because your overall utilization is probably low, but you don't want to see any of those red marks where it's over limit or close to it. So the ranges that generally matter here are when it's below 90. You want to get these. First of all, below 90%, that'll help you quite a bit. But then below 70% is the next, or is even better. Below 50% is even better. Then 30%, that'll take you to the next level. And ultimately below 7% is where you want to target. If you're trying to improve your score to as good as you can get it, that's what you need to do. Now, what I want to mention here, which we'll see a little bit later, is this can update on a very regular basis, depending on when your credit card or when your loan reports to that credit reporting agency. So you might have in a perfect situation, if you knew exactly when your credit card company reported to the agency, if you made a payment one day, and then let's say 2 or 3 days later they report to the credit reporting agency, it's going to show up on your credit score in 3 days. So there's not an intentional delay on the impact. It's all about when things are reported. You could have a situation where, I guess in a crazy example, you have, let's say those 10 credit cards, or let's just say 10 credit cards, and they're all 90%. They're all way up there. Let's say they all report on the same day. So somehow, maybe you get a debt consolidation loan, or maybe you are able to find money. Maybe you get a bonus from work, and you pay those debts down right before they report to the credit agency. You might see a drastic increase in your score in just a couple of days' time. So you might be able to time that perfectly where that works to your advantage. The length of your credit history, or the average account age. So again, this looks at the age of the oldest account. Hopefully that's very old. The older the better. You want to keep those old accounts open if at all possible. It looks at the age of the newest account, which you don't really want a bunch of new accounts. That hurts your score. And then it looks at the average age of all accounts, which obviously if more of your accounts are older, your average age is going to be better. To improve this component, close the newer accounts unless there's really a good reason to keep it open. Close the newer account, but if at all possible, do not close your older accounts. If you've had an account out there for 10 years, keep it by all means. You might not need to keep a balance on it. Let's say it's a credit card. You don't need to keep a balance. Maybe it has a bad interest rate or just doesn't do you any good. Keep it out there. Keep the payment or keep the balance down to near zero, but again, not necessarily zero. Try to keep $5 on it or anything to report it so that they report it every month. Some of them will not report at inactive accounts, and in fact sometimes they'll close the inactive account if you haven't used it in 6 months or a year or whatever. And the other component here, or one other component, is the new credit or seeking credit. So if you open several new accounts in a short period, that's going to hurt your score. Even applying for new credit hurts your score. Now, I will mention here that they supposedly can tell if you're out there searching for the best rate for a mortgage or for a car loan. So maybe you have 10 hits, but it's all for the same thing. it supposedly only counts against you one time instead of 10 times. Now, there's no way to prove that, but that's what they say. On the other hand, credit cards are basically treated as a hit every single time. So be careful with that. Now, they generally, as far as this element goes, they generally just consider the past year, maybe up to 2 years. So it will quickly fall off your report. And again, it's only a 10% impact, anyways. But just be careful with this. Don't go apply for anything and everything, because it will impact your score a little bit. And then I think I talked about the last one quite a bit already, the credit mix or types. It's better to have accounts in all categories rather than just one or two. Now, I'm not saying go out there and get debt just for the sake of getting debt, but if you have them, it's gonna help benefit your score a bit. So home loans, car loans, installment loans, that's kind of one category there. Bank issued credit cards, and there might be other revolving accounts. If you have something in each of these categories, that little 10% of this credit score is going to be improved. But again, if you close the account, it falls off. It no longer benefits you at all. So the last few slides I have here are little tips on how to improve your credit score quickly. Now, I'm not by any means offering any magic tricks. A lot of times you'll see those on television ads that, hey, we can fix your credit report. We can erase stuff from your credit report. Legally, the only thing they can do is remove things that are improperly reported. There's no legal way of eliminating things that might be bad, but they're legitimate. So what I'm showing you for these tips are things you can do within the rules to try to improve your score fairly quickly in some cases. So the first step here is, again, scan your credit report, identify any erroneous accounts or payment histories, and dispute them through the ways that I talked about earlier. As I said a bit ago, if you have any newer accounts that you don't need, feel free to close those. Now, unless they're in one particular category, like the installment loan or the revolving account, and it's the only one in that category, then it's kind of a toss-up as to whether it's best to close it or leave it open. And again, do not close the older accounts. It seems counterintuitive. It seems like you'd rather have it completely off to show I paid successfully and I'm done. It's not a good idea. It's counterintuitive, but do not close the older accounts. It doesn't matter if it had a bad history or a good history. When you close it, it's not going to help your age. Now, the interesting thing is that once that account is closed, let's say you paid for 20 years on that account with a perfect record. Once you close that account, it's like it never existed. That 20 years of positive payment history doesn't matter one bit after you close it, which is so frustrating. It seems very unusual, but that's the way it works. However, oddly, any negative impact remains. If you close the account, and let's say you did have a string of missed payments, it is still going to count against you in a bad way, but it won't help your age. And the age is one of the things you want to try to improve. Now, in some cases, you might be able to increase the credit limit with the company without even counting as a hit. So it's hard to know whether it's going to impact your score, whether it's going to actually count as an inquiry or not. Different companies do it differently. Certainly pay down any over limit accounts. Do that right away, and then within 30 days, hopefully less, you'll see the benefit there. And as I said, you definitely want to start by paying them all off if they're over limit, or pay them down so they're not over limit. But then you want to work on paying the accounts down below one of the aforementioned thresholds, hopefully below 7%, but at least get it below 90, and then shoot for the 70 and then the 50. The average, that's what I'm saying, the total utilization, get that below 50, 30, 7. So that's what we're saying there. And then finally, I just wanted to mention here that you want to identify when at all possible when your company reports their balances to the agency. So some of them take the statement date and then they report a few days later. Some of them, there might be a longer delay. But the best thing to do is look at your credit report detail to try to get an idea on a month-to-month basis when your account is updated each month. Now notice in this example, the screenshot, this one was updated September 9th, so not that long ago. If I was to look at next month, it's probably going to say October 9th or very, very close, depending on what weekday it falls on. So now I know by September 9th or by October 9th, I want to get my balance to a certain point before it reports. Also, notice this is an example of the tip I said earlier. Don't pay it down to zero. Pay it to $1, $5, something like that. That's fine. Just have some balance. Now, if you know what that reporting date is, you might be able to pay an account down and have a very quick impact. If I paid this on September 8th, or let's say September 7th, and maybe this was a, I don't know, $5,000 amount, and I paid it down to $1, that's going to have an extremely quick impact to your credit report and your credit score. Now, one tip here I will say, use this with discretion, but if you're working toward a mortgage or a car loan and you know you're going to be able to pay some of your accounts down, but you need to do it quickly, you need to have a quick impact, you can dispute the balances. Let's say you don't think it's going to report, maybe you missed September 9th. I paid this on September 10th. You don't really want to wait till October 9th. You can dispute the balances to accelerate the impact. It may accelerate them. It doesn't always work. But again, you don't want to do this all the time. Do this if you really need to improve your score for an upcoming loan, car loan, mortgage, and you can't wait 30 days. You might see a benefit from doing this. So again, dispute it through one of the online portals, possibly by sending them a letter in the mail, and they'll check with the agency and they'll say, yeah, here's your updated amount. That might work, it may not. It's just a tip to use, to consider. So hopefully this has helped out. This is actually the first video in the personal finance section of this series. A lot of times I post financial and managerial accounting videos, but I decided to start some of these as well. So hopefully this has helped. If you'd like to check out some of the other videos I have, you can either use one of these links or just type in Severson Accounting YouTube on Google, and that should take you very close to the YouTube page where you'll see some of my stuff. I also have, I know this is a long URL, but I have a spreadsheet that contains a list of all the videos I have, and you can click on that. I'll actually post that in the YouTube window. But thank you for your time today. I hope these tips have helped. If you're planning on improving your score, if you're trying to do whatever you can, just the best of luck to you. And thanks for your time and have a great day.